Okay, this is part two of chapter three, and I had finished up with this, looking at the timeline, looking at your the time period assumption, looking at deferrals and accruals. One thing you definitely want to note is that before preparing our financial statements, we are going to record adjusting entries. So you'll um, record all the regular entries during the course of the year. Then at the end of the year, right before preparing your final financial statements, and what I mean by that is your balance sheet, your income statement, your statement of owner's equity, and your cash flow. But in this chapter, remember, we're really focusing on the income statement and what revenues need to be recorded in the right time frame and what expenses. And the other half of that is looking at your balance sheet. All right, so let's continue. This slide I made up, again, since I plopped it into McGraw-Hill's shell, it just came up down below, but this is my creation. All right, this one is my creation too, and I'm just using six figures. What I want you to know here is that at any point in time, a company will be a buyer, and at another time during another transaction, they will be a seller. All right, so let's look at our deferrals. First, our deferrals, and that's where cash is exchanged, but there's no goods or services. So that means that there's no revenue that will be recognized, and there's no expenses that have been incurred yet. This is, if we're looking at the timeline, in the beginning part of the year. All right, so we have a buyer, and the buyer is going to recognize a prepaid asset and record a decrease in cash. Let's use an instance here, okay, because you guys can read the slide. Um, let's use the bagel shop. All right, so we have the buyer. In this instance, the bagel shop will be the buyer, and the buyer is renting out a location, their bagel shop. And so the landlord requests a year in advance rent. And so the buyer, the bagel shop owner, will pay the seller or the landlord uh, the rent for a full year. And when the bagel shop owner does this, they're going to record a prepaid expense, prepaid rent. That's a prepaid, that's an asset. And then record the cash going out of the business. Later on, as the expense is being incurred, so during the course of the year, so for the month of January, the month of February, March, April, the buyer, this bagel shop owner, will make a journal entry, and this will be the adjusting journal entry where they'll record the rent expense. All right, so we're getting the expense into the proper period and then reduce this prepaid asset. All right, so here the buyer has paid cash but is going to incur the expense maybe into into the future, maybe over the course of the year. All right, let's look at the other side of it. Again, let's look at the bagel shop. Um, well, you know what? Well, let me continue with the landlord. So the seller, being the landlord, is going to recognize this unearned rental revenue. The cash is coming in. So in the beginning part of their year, as the landlord for this bagel shop is going to record the cash coming in, but this unearned rental revenue account, that's a liability. Any time in any title you see unearned revenue, unearned, when you see the word unearned or deferred, it's a liability because say the bagel shop owner decides, you know what, I want to move out of here, the location's not good, you reneged on the contract, I want my money back. And so that's why it's a liability. The seller is liable to give that money back to the bagel shop owner, to the buyer. All right, so that's the initial entry. Now, the adjusting entry for the landlord will be uh, recording the revenue. So they'll credit rental revenue and then debit this unearned revenue or liability account to reduce it. All right, so that's the course of the year. So here um, we had the um, bagel shop owner as the buyer. All right, let's look at that's deferrals. And again, we could have used an instance in this situation where the bagel shop owner is the seller. Let's say somebody comes in and they want the catering of a party. All right, so now the bagel shop owner is on the other side of this and they're the seller. So they're going to say to the customer, you know what? I want a deposit. And when they receive that deposit, they're going to record the cash coming in. But again, they haven't, the bagel shop owner hasn't earned that revenue yet. When they actually cater the party, then they'll record the revenue coming in and remove that liability anymore. They are not liable to pay the customer back the deposit because um, they've provided the service, provided the revenue, and catered the party. All right, so just another way you can look at it. I'm just throwing a lot of examples out there. All right, now let's look at the accruals. Again, there's a flip side to every transaction. A company is a buyer and a company is a seller, in both, it's a flip side of a coin. Now, with our accruals, that's where no cash is exchanged. And so the seller will provide goods or services to the buyer. And the buyer, for example, the buyer places an order for merchandise and the goods are delivered. All right, so let's look at um, the the buyer, again, being the bagel shop, and let's say they order a flour, and the flour is delivered with an invoice. All right, so the bagel shop owner has incurred this expense. The goods have um, arrived, and the bagel shop owner is going to use this flour during the month of January. Well, they're going to record that expense immediately and then record a payable. They're not going to pay the vendor for the flour. Maybe the terms are the vendor says you don't have to pay me until March 10th. And so the buyer is going to hold off and set up this accounts payable. Let's look at the other side, the seller being the seller of this flour, the flour manufacturer. So they're going to ship the flour to the buyer and they'll invoice it, and to the fact that there is a receivable now due from the bagel shop owner. So there's an accounts receivable, and meanwhile the seller will record the revenue. They've earned it. They've shipped the flour. That money is due them now. All right, so that's the adjusting entry. And what you'll notice every time there's an adjusting entry, uh, an adjusting entry affects a revenue account, and then it'll also affect a balance sheet account. So that's where you're looking at your financial statements and you're saying, you know what, this asset is truly an expense now, so I need to recognize the expense in my income statement. Or this revenue that I have as deferred or unearned, I've earned it, so I need to record it now as revenue. Okay, those were our deferrals. In the case of the accruals, right here, these first two entries are our adjusting entries. And so, I've incurred this expense. I haven't paid it yet. I haven't paid the cash yet. So let me record, the expense being a net income, sorry, being an income statement account, and then the accounts payable being a balance sheet account. If you remember, if you look at the chart of accounts that I handed out to you, if you don't have a copy, go out on Ocean Cruiser under Chapter 1. I have a copy of this chart of accounts. And the chart of accounts on the left-hand side shows you the balance sheet accounts, assets, liabilities, owner's equity, and then on the right side I have the income statement accounts, and that's your revenues and your expenses. All right, so I'm babbling here, but anyway, those are our adjusting entries. And then when the buyer actually pays and when the seller actually receives the money from the buyer, these subsequent entries will be recorded. So now the buyer no longer owes this liability. They're paying the cash. We're reducing our cash, so I'll credit cash, and then I'll take this liability off my books and I'll debit accounts payable as the buyer. Now, if we look on the seller side, the seller is receiving the cash, so they're going to record a debit to cash. That's cash being increased. And then the accounts receivable will be removed off the books. Remember, accounts receivable is an asset, and so if I want to reduce an asset, I'll credit it. Okay, we're going to get into each specific type of deferrals and accruals, and this is right out of your textbook, but I'm going to stop here.